This simple piece of information will categorically change your life as a trader. It will categorically change your life, and all you have to do is listen to what I am saying, take it in, and watch this video as many times as you need to until it sinks in. There are so many different strategies out there in trading, but none of it matters unless you master risk management. And I'm going to show you exactly how to not blow your trading account. From now on, I want you to risk 0.33% on your trades, because if you're in a situation where you lose 3 trades in a row, you would have only lost 0.99% of your entire account size, meaning that despite the setback, you have preserved 99.1% of your account. Now I'm going to give you a very simple trading rule you can stick with here, and that is if you lose 2 trades in a row, you are done for the day. No matter what happens, you're done for the day. If you lose again the next day, you are done for the week, and it then becomes impossible for you to ever go over 1% in drawdown on your account in 1 week, which means for you to fail your funded challenge, you would need to lose 30 times to blow your funded challenge. And if you go a few weeks without a trading win, you need to stop trading on a live account and stop trading these funded accounts, because you're simply not ready. And if you're thinking 3 trading wins as a 1% gain, that's not enough, you need to get a bit of perspective, because 1% of £100,000 funded account isn't actually that bad. Here's how I'm looking to frame a setup and a bias the upcoming week. So first thing I always do is I let Mondays play out how they're going to play out. And now I'm on a daily time frame. Monday has played out. The first thing I'm looking for is areas of interest, which price could essentially create a high or a low of the week. So we can see here there's an area of inefficient price action. Why am I interested in an area of inefficient price action? Because the market seeks 2 things: areas of inefficient price action and liquidity. So my target is very, very simple. I'm just looking to try and take price towards this liquidity here. Fast forward to where we are right now, we can see price came into that area of inefficient price action right there. You can see on a smaller time frame, price was looking to travel to this order block right here. Price dropped lower, creating another area of inefficient price action right here, which on a smaller time frame you can now see created a really nice liquidity grab. So my focus would probably be this area of inefficient price action now. And where would I be looking to target? This sell side liquidity here on the daily time frame. I'm not trying to reinvent the wheel here. I'm not trying to do anything that's overcomplicating. My philosophy is just stick to the basics. And once you get really good at the basics, there's really no reason to go and overcomplicate anything ever again. Liquidity. Liquidity is the lifeblood of the markets. If you want to master trading, you have to get to grips with understanding liquidity. Liquidity can be found at every previous high and every previous low. Liquidity can also be found in the form of equal highs and equal lows. So when you see consolidation, that is essentially liquidity building up on both sides. Now, liquidity is money. That is people placing orders and leaving money on the table. So when price eventually takes this high, that is the market's going for liquidity. When the market has reached for liquidity to the upside, which is also known as buy side liquidity, you will then notice price starts to reverse, meaning that the target is going to be sell side liquidity. Understand that the market is engineered to seek liquidity. We can use this for entries in terms of targets. We can also use this as confirmation to enter a trade in this order block here once price has swept liquidity to the upside, targeting liquidity to the downside. So go and back test this. Let me know how you get on in the comments. So allow me just to strip the whole thing back for you. This is a generic candle. You get this on every single time frame, and with every single candle you get an open, a close, a high, and a low. So the reason we're utilizing a daily candle to try and work out a bias and to try and get the best entries is because when this opens right here, you are likely that price is going to manipulate lower before it goes higher, because it will retrace down into some form of point of interest. Now, what do I mean by point of interest? I mean order blocks, areas of inefficient price action, or liquidity sweeps. This is the system I use in Forex and indices and metals. Let's look at today's printed candle so far. As you can see, price opened here. Price went higher first, coming into this point of interest right here. And now it is breaking to the downside, which in turn could end up looking something like this.